Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hi, everyone. I'm Brian Love, head of Banking and Fintech at Travillian. Today, I'm joined by an old pal who's been on the podcast before, Scott Hildenbrand from Piper Sandler. How are you?
Hey, Brian. How you doing?
I'm doing okay. Last time I saw you was in Arizona at the Moody's Analytics Conference. And could you imagine if that conference was held a week later?
I know, right? Of all places to be we're at the Moody's Analytics Conference. That's right.
I know. I wanted to also mention that the last time you were on the podcast, a lot of people came up to me at the conference and reached out after you were on because you talked about having your balance sheet as a weapon, weaponizing your balance sheet. And the gist of this discussion today is one of those weapons kind of detonated to some degree. So I'm really excited to pick your brain as a balance sheet strategist over at Piper Sandler and talk to you about where we are in banking in the kind of the aftermath of these failures. I also wanted to introduce my colleague, Indra Elangovan, and she's going to get us started.
Hello, I'm Indra Elangovan, Head of Strategic Advisory at Travillian. As we all know, banking is an industry built on confidence, credibility, and trust. Depositors, regulators, and banks want to ensure that we have a stable banking system. A huge hole in the balance sheet by the underwater held-to-maturity securities book, approximately $15 billion in unrealized losses as of fourth quarter 2022, large enough to wipe out equity, spooked depositors that led to the collapse of Silicon Valley Bank last week. My first question to Scott is, banks large and small have massive unrealized losses from the held-to-maturity debt securities on the balance sheet, from the unprecedented speed and magnitude of interest rate hikes in the past year. Bank of America has $113.5 billion unrealized losses on its balance sheet, representing greater than 60% of tangible book value. It begs the question, are the big banks safer and stronger after all, compared to the smaller community banks?
Right, good question. And I think there's a couple ways I would look at this. And I don't mean to be flippant a little, but I believe that while we're all called banks, the largest banks in the country versus the other 4,500 that I spend a lot of time with, I wouldn't classify them as anything as equals in terms of the way their balance sheets are constructed, the way they behave. And so the first thing I'll tell you is, yes, those HTM bonds are very concerning from an unrealized loss perspective, no doubt. But if you think about the diversification and the deposit base of Bank of America versus what we just witnessed with Silicon Valley and Signature and a few others, that immediately alleviates some of the concern. So you have to think about also the largest banks in the country don't rely so much on spread business as the other 4,500 or so banks in this country. So it takes a little bit of pressure off of a lot of what the largest institutions are doing because they're receiving fees. They've got a wide diversification of deposit base. And so they have half the problem. They do have the unrealized losses. I would argue that their deposit base is nowhere near, would never look like what we've been witnessing with a couple of these with large uninsured. They've got diversified across many different areas. I'd say that, but I do want to make one other really quick point. If I was a betting man, I would tell you that if I'm an examiner and I'm looking at the other 4,500 banks in this country and you show me an HTM bond, I show you I don't care. We are now going to head into a world where AFS and HTM for the community bank space, I believe, whether FASB addresses it or not, I believe the examiners are going to take a hard look at held to maturity and available for sale and essentially make you mark on balance sheet, not through earnings, but on balance sheet, your entire portfolio of securities and go back to the root of why we have a bond portfolio at the community bank world, which is for liquidity and which is for interest rate risk. And so we have to remember that and kind of go backwards a little bit and think that through. So hopefully that addresses the question, but that's how I would think about it.
I'm glad we
thanks.
talked about the diversification benefits that large banks have. ICBA denounced the statement from the Treasury Secretary Yellen yesterday, saying that they would bail out banks that are systemically riskier than the community banks, and they are now prone to take more risk and maybe greedy risk taking. What are your thoughts on that?
Yeah, no, I'm very upset, right? Because being a community bank lover and spending as much time as I do with so many, the first thing that I thought of on Sunday night when that announcement came out, I said to myself, maybe this country only wants to have 5 banks. That's literally, and then Janet Yellen coming out and saying this yesterday, that combination alone is so concerning. And here's the other thing. We have what happened late last week and early this week, but you know who's going to deal with it? The rest of the 4,500 banks in this country are going to have to change their business models to bring on more liquidity, probably a little bit less earnings, a little harder to earn their cost of capital, based on, again, some of the largest banks in this country having an interesting niche business that had a risk that isn't interest rate risk in its core. Right. And I think interest rate risk played a part and balance sheet management played a part. But let's get back to what that really was the spooking of how much an uninsured and the size and average deposit size at those institutions. So I'm very concerned, honestly. I'm not happy about, especially yesterday, but even the messages that are being sent on Sunday that, it wasn't every uninsured. It was those two, because that was a systematic risk. So what does that tell you, and where does it leave the other 4,000 or so banks in this country? I'm very frustrated, to be honest, with that announcement.
As this all has been on unspooling, it's gotten everyone, a little scared. But as the dust settles, from what I'm hearing, just kind of polling my community bank clients, there's not been a lot of outflows at a lot of these smaller banks. In fact, you're hearing some great stories of inflows. Because the Silicon Valley Bank depositors need to go somewhere, and they need to bank. I think there's some good news that may come out of this. Do you agree with that?
Yes, and at first, Brian, it was hard to see any good news,
right?
Because I literally thought every dollar, either indirectly or directly, is going to the largest 3 or 4 banks. Right on Sunday night, if you had polled me then. As I've talked to a lot of banks throughout the country, there's been some inflows as well. And and I hate to say this, but there's almost this perception issue of 95% of the banks I talk to, maybe even more, are not on the list that look anywhere near remotely how the others do. And so they actually may see some inflows here a little bit, especially around the smaller average deposit size. I think the challenge becomes 2 things. There are a few banks that are being fairly or unfairly judged based on their business model and the relevance to maybe some of the ones that have had some struggles. That concerns me a little bit. But here's the other concern I have. If you are now as stressful as this weekend was for all of us, if you're a corporate treasurer of a company that was banking at Silicon Valley, how do you think that weekend went? Not good, especially when you thought about telling your CEO, telling he or she, and you telling your board of directors that actually we had $25 million and about 24 million of it was uninsured. I didn't sleep overnight. We get into Monday. What do you think the first thing you're going to do? You're going to think about, where am I going to go where I know, no matter what, even if I have a great relationship with my local bank, love my local bank, where am I putting my dollars? Most likely at the largest institutions in this country, because going to the board of directors and saying, I put my money at JP Morgan, I feel like job security just got a little bit better versus any other decision. It's not fair. I don't agree with it, but right? Like, that's just how I think about putting myself in someone else's shoes.
Yeah, well, and so, you mentioned the role of treasurer. I was thinking a lot this week about the role of CFO, chief risk officers, right? talent is a big part of this story. And it's kind of interesting because I can't, point fingers at the people at Silicon Valley Bank and Signature and even Silvergate, but I am kind of interested in how talent bleeds into this story. And you know as well as I do that there's, as banks get less complex down the ladder and there's smaller asset sizes, there's different needs at the top of the house. But, is it possible that some banks may be a little bit outmatched with some of these macro issues? Do you feel like some of these banks will need to up their game in talent or skill set? And does this change what a CFO may need to look like in the future?
Absolutely. As I think about the CFO role, even I've been doing this for 23 years, just thinking about how the CFO role has adapted and changed. I will tell you that there are some banks, and I never look at dollar sizes of assets because you get a wide range of talented people at different places. But what I will tell you is just because the products on your balance sheet are the same as they were 20 years ago, they don't behave the same way. There's optionality risk today that is much different than how almost all of us grew up in the bank world thinking about balance sheet management. So do I think it's a talent thing? It's not a talent gap from an intelligence perspective. It's a willingness to recognize that balance sheets have changed dramatically. Customers want things that are different, and we can't model and treat and strategize the way we did even 10 years ago. And you've probably heard me say this, Brian, many times, but if you go back to 2006 and 2007, 40% of deposits on bank balance sheets were in CDs. Think about that. That gave you a weighted average maturity of about a year to give you time to handle quick moves like we just saw. That's nowhere near where we were coming out of the pandemic when all those deposits came in flowing. So to think that we're going to model and look at our balance sheet the same way that we did even 10 to 15 years ago is a huge mistake. Interest rate risk is important. Your balance sheet risk is way more important. It's not the rate change. It's how your balance sheet is going to behave after a rate change and after the information flow that's so much faster now to your customers. And we've got to be much more nimble. So I would say the talent is there, Brian. I think we've got to really overhaul, in my opinion, the way ALCO is done, the way balance sheet management is done. I've screamed at this for a long time in my career because I always felt like a lot of banks treated ALCO like a dentist appointment. Couldn't wait to get the heck out of there, checked a few boxes and moved on. And really thinking differently about that ALCO room. And I think this is gonna lead to some of those changes.
No, I appreciate that. It's a great perspective. And I had the ALCO as a dental appointment. You're a man of many analogies. I love it.
You have a low IQ. I have to use analogies to get myself to the right place.
Nice.
Yeah.
Indra, I know you wanted to hop in with a question about M&A.
Yeah. In terms of M&A, higher interest rates mean higher hits to buyers' banks' tangible book and higher credit marks with increasing potential recessionary risk. Can we expect the M&A headwinds caused by rising interest rates and corresponding interest rate marks on both the loans and securities to further exacerbate with increased regulatory scrutiny?
Yeah, so I would answer the question in the following way. I would think about it like this. In the short term, volatility just slows the M&A wave down no matter what, whether it's lower rates dramatically, higher rates dramatically, heading into a recession, without a doubt. Over the last 2022, we spent a lot of time looking at buyers, looking at sellers, and looking at the marks from an interest rate perspective. And we hadn't even gotten to potential credit perspective. So any news so far on the M&A front, given the fact that Silicon Valley was not a credit issue. There was a lot of issues, but it wasn't credit. And so that's an interesting thought process. I think over the long haul, if it goes in the direction that I believe, where the examiners are going to come down even harder around liquidity, and we're going to have to pay up for more liquidity, once we start to see and get a better feel for the end of the road in terms of attacking inflation, I think you're going to see a very large pickup in the M&A front, or at least a lot of discussions, because I think it's going to be really hard to earn cost of capital. I think people have now gone through the credit crisis. They went through the pandemic. Now we're going through this liquidity and inflation. It's exhausting and very challenging. So You're right. Short term, I think it's gonna be really difficult because you're trying to buy something that's a moving target. We're not quite sure what it looks like yet. 6 months, 9 months, 12 months down the road, I think that pendulum will swing, as even if we know it's a recession, we can at least everybody calm down. You know, you poll 5 bankers today, some tell you the world's great, some tell you the world's horrible. That's a hard area to get 2 banks to agree on things, right? And so I think as we get closer to having a little bit more clarity, we'll start to see a little bit of a pickup in that. People are talking for sure, but I think I think you need a little bit more clarity around where we are. And that could take a little time here, given what's happened this past week.
Great perspectives on the already challenging M&A landscape. With that, I'll turn it over to Brian to talk about the 2008, 2009.
Yeah, and Scott, you had mentioned the financial collapse from '08 just briefly there. And by the way, to your M&A point, I also feel like people have been through that collapse. They were through COVID. Now they're through this, this weekend of terror. That might probably prompt some folks that are maybe aging out to say, all right, enough is enough. I got to get down to Florida and retire here. Do you think that, I just kind of curious, you think this maybe expedites some people's notion once the dust settles once again?
Yeah, I think once you right the ship, you may say to yourself, if I don't have a great succession plan, which, as you all know very well, much more that you've forgotten more than I know on this topic, but, I typically hear this. It is a difficult, it's a difficult thing to nail down. You get your institution through this, and you may say to yourself, you know what, they've got a great succession plan over there. I like their balance sheet. This will be great for my shareholders. That to me is a great ending so that we can deliver better products and services and technology to our client base from a scale perspective. So I think there is a little banking fatigue, probably at some point gonna weigh down a little bit as well. I hope not, because there's some phenomenal bankers I love working with, but that may be the case.
Yeah, I mean, I actually had a full head of hair last week, and so anyway, I wanted to ask you though. Indra had kind of propped it up, the playbook. Everyone went to their 08-09 playbook, right?
Yep.
Then they realized that playbook doesn't really work because nobody's interested in bailouts. Although, and First Republic kind of had like a joint internal bailouts, so to speak.
Yeah.
But what is the right playbook going forward? And then also, how will risk management evolve in terms of hedging strategies and balance sheet management?
Yeah, no, and I'll tell you, our hedging business, which I probably started for maybe in 2016, probably had its best quarter this quarter that's ever had. So it has sparked, and again, even before last week, you think about the velocity of interest rate movements. We've all seen interest rates move. What we haven't seen is in such a dramatic short period of time, combined with the new world that we live in of balance sheet management is nowhere near what it used to be. And I'll say this, and all the asset liability modeling I used to do, and I joke with Brian and many others, I actually used to do modeling, Brian. I swear I used to get there and do some work, and I don't do it anymore. But when I used
to for magazines and
never for magazines, that phone
okay.
never rang. That phone never rang. It was more on the asset liability model. But we would always look at and think about the golden egg. The best thing on a bank balance sheet was operating and checking accounts. It was the easiest thing to model. You had it there. It was phenomenal. Those people aren't moving. Everything else we'll go in and we'll dig in and make sure we have it. It was flipped on its head over the weekend. Flipped on its head in terms of, wait a minute, those operating accounts that we used to put in our models that said they'd be around for 6 years to try to estimate the value, they'll be around for 7 or 8 years, but now there's an asterisk. It's got an optionality risk to it that it can be pulled in 1 month. And that is how we're going to have to start thinking about our balance sheet differently. Said simply, it is going to be a much harder, your balance sheet is much more nimble. It's going to move very quickly. And so we as managers have to stop making decisions based on rates today and have to really start thinking about where our potential exposure is based on the behaviors in the future of what our balance sheet could look like, and get hedging strategies and other strategies in place now. The decisions you made 2 years ago are being played out right now. So the decisions we're making now are going to be played out over the next 12 to 18 months. And if you're not overhauling, the way you think about your deposit base, the granularity you have to get in and understand the demographics of your deposit base, right? The older, and I'll put myself in there, but the older camps of depositors, right? They've got a ton of loyalty and very little trust. I get a check, I want to go to a branch and make sure it's in. My father, the same thing, right? The younger generations, they've got a ton of trust and very little loyalty. They'll move money, they'll move $30,000 on their phone and not think twice, right? And that makes my parents, mind blow, right? Thinking about it that way. So we've got to go into things and think about things differently and really not choose all checking accounts as equal. They're not even close. We've got the uninsured issue. We've got to figure out how the messaging of what's really uninsured, because all the reporting numbers are not right. The reporting of uninsured is not correct in this country right now. They're not factoring things in like reciprocals and others. So we need to make sure we message what we're doing and model and impact that very different than what we have been doing.
And I guess just one little thought. I mean, I've heard so much right there, products and being creative around what your products are, funding, of course. Do you think this puts an extra onus on financial planning and analysis, that FP&A background over accounting? Like back to that talent question and skill set, even marketing, it sounds like is in there too, understanding your customer base. Remember, we heard from someone at SoFi who talked about how they're talking to their younger generations. There's so much to unpack in what you just stated. Maybe too much for this conversation, but any thoughts there?
Yeah, no, I think the old rule of thumb was give me a great accountant and I'll teach them strategy. I think now it's the other way around. Give me someone that's got a lot of strategic, forward-thinking thoughts, and we'll get them the accounting skills. And I originally remember, I think I had that decision to make early on in my career. Was I going to go into more of the strategy and asset liability role, or was I going to go more in the accounting role? And I chose, probably didn't get into the accounting side, so they put me over here on the other side. But I think that's really where this world is going in the bank space, because it's a much more strategic game than it was even 10 years ago, but certainly more than 20 years ago.
Okay, I appreciate that.
Yeah.
We will now get to our last question. Given the magnitude of the uninsured deposits and concentrations in niche industries, could we see an explicit guarantee around uninsured deposit protection, not just an implicit guarantee based on the two most recent failures?
So if I had a vote, which everyone knows I don't, but if I had a vote, on Sunday night, I wish they had come out and say all uninsured deposits for 12 months will be insured. And what we are now going to do is get our ducks in a row. We've all been caught a little bit asleep thinking about the magnitude of uninsured deposits and how quickly they can move. We're giving everybody 12 months to get everything in order. That, to me, would have been a more forward-thinking approach. People probably argue and disagree. But I now, after reading Janet Yellen's comments and reading some of the tea leaves, I don't foresee that happening. I don't think they're going to come out and guarantee all uninsured, explicitly all uninsured deposits. I do think there is this, I don't know what the right word is, but it's almost binary. Are you systematically going to drive problems to the industry, or are you not large enough? And I hate saying it that way. And if you're not, I'm not worried about you from that perspective, but I am going to examine you even harder. Right. That's the challenge I think we get back to in the beginning. So at the moment, and I'm probably being too harsh, but I'm just frustrated with some of those comments. At the moment, I don't feel like that this is going to happen. We're going to see that, but maybe it will over time as we all sit back and digest this a little bit.
Great insight, Scott.
Yeah. And on that note, no, I think there is a lot more digestion that needs to happen over the next few weeks. But this is great food for thought. And I think we covered a lot of territory today. And as always, we appreciate your perspective, your insight, your amazing analogies. And we look forward to getting you back on maybe in a few weeks and kind of seeing where we're at that point.
Yeah, it would be great to get on in a few weeks and we'll just count all the things I got wrong. We'll just kind of work through it. but that's how you learn. And this is a great learning opportunity for all of us as you think about the world and the banking space and as it changes. And so I appreciate, Brian, I've said this to you many times, and I appreciate your firm and what you're doing. And you're constantly delivering great content. So thank you for that. And it's an important role that you play on top of all the other things your company does. So I appreciate you both having me today. It's been a lot of fun.
Yeah, thanks so much, Scott. Appreciate it. And thank you, Indra, as well.
Yep. Thank you, Indra.
Thank you so much, Scott.